Welcome, welcome. It is Wednesday, September 24th. I see Lewis. Thank you for being here. I sent you a message. I think Lewis was the one that, and forgive me if I'm not pronouncing the name right. Um, we this is classic business owner, right? I'm the bottleneck. I I thought the system was in place for these webinar recordings to be downloaded and uploaded to both YouTube and to school, and there was a disconnect in the process. So that has now been fixed, and by the end of the day, we will have all of the past webinars that we've done up to this juncture uploaded. And in the VIP community, if you're part of our VIP community, just remember the video replay we always put in YouTube and in our free school community. So you'll always get the video replay of these workshops. The workbook, if you're looking for the workbook that goes along and ties and connects in with this webinar, the topic, it will be found in the VIP community. So that the workbook is where we get the VIP community. Yes, so that is where those workbooks will be found. So you got to be part of our paid community or VIP community to get access to that. So thank you for calling that out and letting us know. All right, I am gonna let's get rocking and rolling. Your time is valuable. I think the chat is still disabled. Forgive me, technology. I do taxes, folks, for a living. Technology is not my jam. They're brighter people than I, that deal with that kind of stuff, and we're working on kind of pulling some things together. So if that's the case, we're probably going to switch platforms. I don't want to switch platforms and then switch back after a week. So I'm doing some due diligence on Wistia, a different platform for webinar presentation, but that likely will go into effect next week. So hopefully this is the last week we don't have the chat live. But apologies if you're here live and not able to chat. Use the Q&A if you have questions or comments. I'll see those Q&A posts pop up there. Today, we're going to rock and roll and work on tax credits, deductions, kind of saying here's what the difference between deduction and credit. So we have tax deduction, but a tax credit. So in today's agenda, we're going to introduce tax credits, what are tax credits? We're talking about workers' opportunity tax credit, retirement plan startup credit, health insurance premium credit, R&D credit, employer provided childcare credit, and ADA compliance credit, right? So a big thank you for being here. Your time is incredibly valuable. Our motto is, or slogan, if whatever you want to call it, friends don't let friends overpay the government. Most people tune in because they probably feel like they're paying way too much in taxes. In fact, they say, I love paying taxes, said nobody ever that I've ever encountered. But at tax time, you feel like your taxes can be, you've barely survived 12 rounds in the boxing ring with this guy, right? Entrepreneurship, you've just always already feels like you're getting beat up daily. That's me. I just was transparent, confessed to you my technology woes and the fact that there was a gap, right, in the process. So I get it. I'm an entrepreneur myself. And taxes just add to that feeling. In fact, the IRS has designed what I call a system of confusion. This is a visual representation of the taxpayer roadmap. And I say, how about a roadmap of confusion, right? So it's no wonder that most busy business owners, when it comes to their taxes, their reaction is this. They're like, hey, my CPA's got me. They got their head in the sand. But sadly, your CPA, most CPAs don't have you covered, right? Most CPAs are what I would call happy historians. They put the right numbers in the right boxes. But as a result of that reactive approach, it feels like this again at tax time, total knockout. You just got your butt handed to you by the government. Right now, I think we're working on 10 tax strategy roadmaps, and we're finding 50 to 70, like one guy, we were cutting his tax bill by 77%, right? So navigating this maze alone is frustrating. And a lot of people try asking their friends, searching Google, asking their CPA without getting any real results. But that changes today because we're going to dive into actually a plethora of credits. We're going to talk about a few um, things to put on your radar. And I'll tell you why we're talking about that specifically today, because we're coming up on the end of Q3, right? But before we get too much further, who's this bald guy barking at you on the screen, right? My name is Chris Middleton. I'm a husband, father, goofball. Yep, I love my dad jokes, entrepreneur. I've been a business owner since 2006. I've had an accounting degree. I'm a tax professional, enrolled agent, and a tax strategist. We are Make Taxes Fair, a proactive tax firm that focuses on tax strategy first for entrepreneurs. We do handle tax compliance, filing tax returns. We partner with amazing people that do bookkeeping and payroll. We have great attorneys on our team and referral network. So you have a business issue, we have the solution either directly ourselves or through our network of amazing professionals. Our name is our mission because we exist to make taxes fair. And again, as Lee said, friends don't let friends overpay the government. That is our mantra. So the tax strategies we're talking about today fit into what we call the Clear Edge framework. The Clear Edge framework is, I'm not going to read it to you. You can read. But credits, right? Credit optimization is at the very top. Typically, when we start working with a client, we start with legal structure. So we shuffle the deck on the Clear Edge and start with legal structure first to address those issues, because then that a lot of other strategies hinge on legal structure. But today we're going to be deep diving into credit optimization. And I would guess that we put the time, energy, and effort into protecting our framework. It's trademarked and protected. So anybody that tries to copy that, it's like, well, that's ours. It's been developed by ours, to be ours. But I would guess that most people, when working with a CPA, haven't been exposed to or be given a framework, right? And so we find that that's the magic, to look at the your taxes through that framework. So let's lock in. If you've got the playbook or workbook, or if you're watching the replay and you've got the workbook, lock out all distractions, warm up that pen or note-taking device, and let's go. So today, tax credits. Let's introduce some tax credits. Who here loves incentives, right? I'm a sucker for an incentive, or a discount or a sale, right? So I like incentives. And in the Internal Revenue Code, or the IRS tax code, there are dozens of incentives you can cash in. They're just laying around. Tax credits are those dollar for dollar rewards you can potentially put right back into your pocket. Yeah, I guarantee most business owners miss out on opportunities they're qualified for simply because hasn't been brought to their awareness. I'm going to show you something. So the IRS definition of a credit is, a tax credit is a dollar for dollar amount taxpayers claim on their tax return to reduce the income tax they owe. Eligible taxpayers can use them to reduce their tax bill and potentially increase their refund, right? So let's dissect that. There are two types of credits that can determine whether you get money back or just reduce your bill to zero, potentially. There's refundable credits and non-refundable credits. Non-refundable credits are, it just reduces your tax liability. So if you make $1 million, let's assume a flat tax. I wish, but assume a flat tax of 10%. So 10% of $1 million is you owe 100 grand. Well, I actually helped a client capture about a month ago a tax credit that was worth $100,000. $95,600 was the end credit that we captured, right? Huge credit, massive credit. Well, if he had owed 100 grand, that credit of 96,000 something dollars would have dropped his tax liability. Instead of owing 100 grand, he would only owe like 3,600, or just under 4 grand. That is a non-refundable credit. It just reduces your liability. So if you owed 100 grand and you had $150,000 credit, that would drop you down to zero. You'd have $50,000 credit remaining, and that may or may not carry forward or roll forward, right? Depending on the credit. Every credit is kind of structured a little bit differently. But that's the idea of a non-refundable credit. It'll take you down to zero, but it won't produce a refund for you out of it from your liability. Now, refundable credit can reduce your tax liability to zero and gives you the ability to add to a refund. So same scenario, you owe 100 grand in taxes You have $150,000 refundable credit. Let's assume you made no other payments in there. It's like, hey, I gave the government 100. Government owed me. I owed the government. There we go, 100 grand. But I said I have a credit of 150, so you're gonna reduce that $100,000 bill to zero and give me 50,000 back. That's how a refundable credit works, right? And so the credits are not the same as a deduction. They are a dollar for dollar value, whereas a deduction, if you have $100,000 deduction and you're in the 24% bracket, that deduction is only worth 24,000, right? Whereas a credit is dollar for dollar. Tax credits are considered below the line, below the adjusted gross income and taxable income line, and whereas business expenses are above the line. They're above the line, meaning above your adjusted gross income to as a deduction to get you down to that AGI limit. So imagine this: you see something at the store and you buy it. Well, that's a business expense, right? You go to the counter and you say, hey, the cashier gives you $50 off your bill. That's a credit. It reduces your overall bill. So the bottom line is this, and you'll see this as we dive into these different tax credits. The IRS incentivizes, the government is incentivizing you for the activities you do in your business, right? Business expenses, those are deductions. So there's economic incentive there, but credits really turbocharge that economic incentive and are a means by which the government says, hey, we want people out doing this type of thing. So we're going to incentivize that through a credit. You'll see that illustrated here in just a moment. So let's go over some of the common credits that we see for business owners. And there's dozens of tax credits, dozens of credits. The most often missed credit, we're not talking about it today here, but is state tax credits. There, we actually compiled a whole list of different credits by state, and we discovered dozens of credits. Again, I helped a client about 3 months ago, a couple months ago. We found $100,000 state tax credit, massive, massive, that took 100 grand off of his state tax bill. He's gonna owe in the neighborhood of about 176 grand. So that credit dropped more than half of his state tax bill down. We're working on the other half of it through other strategies. So first one is the workers' opportunity credit. Well, I hear people talking about, and we're hiring, we're bringing people on board to our team, and it's hard to find work, right? It's just a competitive environment. Well, the workers' opportunity tax credit incentivizes you, the business owner, to hire certain people in certain demographics, right? So the workers' opportunity is a federal non-refundable credit that rewards businesses for hiring people from certain targeted groups who could potentially face barriers to employment. Some of those targeted groups are qualified veterans, qualified ex-felon, vocational rehabilitation referral, a SNAP benefit, commonly known as food stamp, qualified long-term unemployed person, and there's a few other categories. I think currently there's nine. There's nine targeted groups. So when it says qualified veteran, let's dissect that. Qualified veteran is somebody that's separated from service within a year, right? They have to have left the service within a year. Qualified ex-felon, they had to have been released from prison, serving their time within the last 12 months, the year. Qualified long-term unemployed person, they have to have been unemployed for consecutive, I believe it's either 36 or 39 weeks, right? So there's a period, there's criteria for each person. That's why it says qualified. So that's kind of the important factor there. You also need to understand, hey, that this credit can range from anywhere $2,400 to $9,600 for the first year, for year one wages, right? So it can be substantial. It can be a substantial credit. So how do we receive this credit? Well, first of all, if you we work with people, and we were working with a client, he's like, oh man, I've got 3 people on staff that we they recently served time and you know made a dumb decision and paid their debt to society. So can we claim the credit? Well, one, they're already on their staff. They're already hired. So right out the gate, not eligible because you have to pre-screen. You have to have this as part of your hiring process. Once you hire, they start, from the date that they start the job, you have 28 days from the date that they the final hire date. It says hire date, but it's start date. So once they start, you have 28 days to kick out the required paperwork to connect the dots to the state workforce agency. The state workforce agency in California is the department, EDD, Employee Development Department. Every state is different, but each state has their own workforce agency that they verify. Hey, that person was on unemployment. Hey, that person was released from the military. Hey, that person was released from prison. So they confirm the status of that person and they send you a certificate. They verify that that person is, hey, you got the paperwork in within the 28 days. Here you go. Here's your certificate. That person is eligible. Now you need to track the hours and track the wages because there are minimum timeframes per demographic, and then file the form 5884 with your taxes to claim the credit when it comes to tax filing time. So there are steps in the process, right? So the biggest question that you need to ask yourself is, are you screening for WOTC eligible employees? If you're not, put out your hand, and slap it, right? Pause, take a minute, say, hey, I could be hiring people that could be eligible for this, but they're not eligible. I can't claim the credit if I've already hired them. They're already working for me. Tough cookies, right? We lose that opportunity. I kid you not, I had a client because I told them about this and they said, baloney, Chris, this isn't going to work. I'm like, what do you mean it's not going to work? They're like, no, this isn't going to work. And I'm like, dude, it's an IRS form 8850. Like, what do you mean? It's a legitimate IRS form and program. Like, what do you mean it's not going to work? And turns out they had been screening. They had been finding out, hey, we hired eligible people. They had determined they were going to get around $56,000 in credits, and they filed for it, but they got denied because they didn't have the missing element was they were not submitting the paperwork to the state workforce agency within that 28 days time frame. So they flat out missed $56,000 of credits. That's huge because they didn't understand and weren't following that process of, here's what we need to do next, right? Huge. That could be, and realize not everybody that walks through your door, not every applicant that fills out your application for a job is going to be eligible, right? Maybe 4 to 10% of the people, depending on the industry. If you're in blue collar, you tend to have more people that fit one of the 9 demographics. If you're, a tech in the tech space, maybe not, but maybe that person was unemployed for a period of time, right? So it just depends on your industry and depends on, how often you're hiring, but definitely worthwhile to examine and say, hey, is this something that we should be screening for? Because could be surprised, hey, that's a $2,400 to $9,600 credit depending on the person. I had a guy, he had missed a $5,600 credit because he just didn't know that he needed to screen for it. Anyway, grab the workbook, run through the exercise. If you're not screening for WOTC eligible employees, you should be, and the workbook will kind of help you do that. Again, the workbook is available inside of our VIP community. We are posting as of today. We've got all the past webinars posted in for replays, posted inside of our free community, and they'll be posted on YouTube. But the workbook, the execution branch of this, is found in our VIP community, or if you're working with us one-to-one. All right. Next up, retirement plan startup credit. This is pretty cool. So did you know that there's a credit where you can reduce your tax liability just by starting up a retirement plan within your business? So it's really a double whammy in the sense that you're stacking away money for the future. I saved too much for retirement, said no one ever, right? You're reducing your tax bill now and you're getting a credit for implementing a retirement plan. So retirement plan startup credit is this. It's up to $5,000 per year for 3 years. Folks, that's up to 5 grand per year for 3 years. That includes the credit. You get a dollar for dollar credit of the ordinary and necessary costs of starting up a SEP, simple IRA, or other qualified plan, 401k, that type of thing. So ordinary and necessary costs, that means setup costs. So if there's a professional advisor that's on fee-based, charging for their time, then their costs would be part of that. The cost of the initial setup with the provider, right? Depending on the route you go, those fees can be fairly minimal. They can add up. The administrative fees, so the annual service fees paid to maintain the plan, record keeping and compliance services, software or platform fees for management of accounts. Again, not AUM. It can't be a percentage of assets under management. It has to be software or platform fees as stated by the provider. So you have to dissect the cost a little bit. But then here's the opportunity that I find: employee education. So, hey, we started a retirement plan. Hey, we want people to participate. Okay, so the cost of educating them, let's pull people in, have a workshop or training around that plan. Well, if I'm the owner of the business and I'm helping to facilitate that, my time on an hourly basis, preparing for that meeting, running that meeting, following up after that meeting, one-to-one questions, or the time of my HR person, those costs should be tracked, traced, and put out there for, hey, this is part of the cost of executing this plan. That, I think, is where most people miss the opportunity to say, hey, the setup fees are minimal, the admin fees are minimal, like $300-400 a year. Cool. But what about the time of your people to help your people train and do those things to execute? You want to avoid the double dip. You can't take both a deduction and a credit. You have to choose one, right? So if we're talking about, hey, allocating my HR person their time, we have to look at and say, okay, let's carve away their time from the salaries and wages deduction and steal that over to capture the credit, right? If I have a choice between saying, cool, I'm going to deduct $1,000, or I'm going to take a credit for $1,000, the credit makes all the sense in the world, right? So that's what you want to be doing. Retirement plan. Who qualifies for the retirement plan startup costs or credit? You have to have less than 100 employees who earn a minimum of $5,000 in the previous year. You have to have at least one non-highly compensated employee that participates, and you have not to offered a retirement plan to the same employees in the past 3 years. So this is really designed for, again, government incentivizing people to do certain behavior. So they're incentivizing people to say, hey, let's have a retirement plan and set that up for our employees, right? What is a non-highly compensated employee? So somebody other than yourself, your family, or a high earner making 150 grand or more. They must be eligible to participate in the plan, even if they don't actually contribute, right? So they don't have to actually contribute themselves from their dollars. You can have the plan there and it's elected, like they just have to be signed up and participating. Ideally, you want people to participate. There are some limitations. If you have less than 50 employees, you get 100% of eligible costs, again, up to $5,000 per year. If you have 51 to 100 employees, it's 50% of the costs up to $5,000. And after 100 employees, sorry, this is designed for that small business to claim. So to receive the credit, you got to open your plan, the SEP, the simple 401k, keep records of eligible costs, and then you file the IRS form 8881 with your tax return, right? So the tax credit, this is a combination play, right? Tax credit that you get, again, up to 5 grand per year for 3 years, plus the employee retirement contributions, right? If that's considered a fringe benefit, you're helping to reward, retain, and keep your people happy, can both yield massive tax savings, right? So if you are not currently running a retirement plan for your company, you're like, oh shoot, I didn't know that I could get a credit for the retirement plan, implementing that. Grab the workbook. Let's go. Let's get a plan implemented. We're coming up on, I believe the deadline for 401k safe harbor plans is October 1st. So folks, you got till like next week to get a 401k safe harbor plan in place for 2025. After that date goes past, there's still plan options. You can do a simple, I don't like SEP IRAs, but you can do a SEP. You can do a non-safe harbor 401k, but I believe the deadline for safe harbor 401k is October 1st. So just be aware of that. Moving on, health insurance premium credit. So you caught on to the theme, right? There are certain things that the government wants you to do in your business, and taking care of your employees is one of those. So another way you could reduce your tax bill is and take care of your employees is through the small business healthcare tax credit, right? That's a mouthful. Say that 3 times fast. So this is a non-refundable credit that helps small businesses cover the cost of employee health insurance. So you can get a credit for up to 50% of the premiums that you pay for the employee. 50%. So if that's 10 grand a year, I could get a $5,000 credit, for example. That's fairly substantial. Who qualifies? You have to have fewer than 25 employees. You have to have average annual wages of less than, that's a greater than, it should be a less than 56,000. The employer needs to pay at least 50% of those premiums. And coverage, this is where the opportunity is missed. Coverage must be purchased through the shop marketplace. So what is the shop marketplace? Well, that's the government. It's basically like your state, the health insurance exchange. In California, it's covered California. In Minnesota, it's MenShare. It's called different things in different states, but it's the insurance exchange in your state, but for businesses. So you have to have a shop qualified plan. You can check that out at healthcare.gov/small businesses, right? That's where you can go to check that out. And there's actually a calculator that you can kind of calculate, hey, what would my credit be? So the small business healthcare tax credit only applies to premiums for the employee. So if you're an owner, you're excluded. Family members of the employee, that's excluded. So it's only the credit for the premium paid for the employee. You can only claim the credit for 2 consecutive tax years. And again, you have to use the shop plan. So to receive this credit, you must offer health insurance through that shop marketplace. Do I sound like a broken record? I am, because that's critical. You got to get it through the shop marketplace. You got to pay at least 50% of the employee only premium, and then you file the 8941 tax on your tax return. So if you're not offering health insurance yet and you're ready to, you should definitely check out this credit. The reason why we're talking about credits right now is we're approaching the end of Q3. Tax credits are a super powerful way to slash your tax bill, but there's runway needed. You got to have time to implement some of these things. So check this out. We're going to talk about employer provided childcare credit. Who's ever had an employee that needs to take time off, right? Because their childcare flaked on them, or that's me. I mean, today, thankfully, I don't have anything scheduled, but I have to fill in the gap for who normally is watching my kiddos and picking them up from school because that person's sick. In my case, it's my amazing wife. So she's not feeling great. So I'm going to step in. Perks of being self-employed. But I feel it too, right? Everybody feels that. It's generally not the employee's fault. Like they're relying on somebody else. And childcare could be one of their biggest bills, out of pocket expenses for the whole year, right? Keeping your little people alive is not cheap. So this next credit not only allows you to support your people, the people that are important to you, but by helping them pay some of those expenses related to people that are important to them, their little people, right? So employer provided childcare credit. This is a federal tax credit available to employers who either provide childcare facilities for their employees, like on site. Hey, we have a daycare facility on site. Or, yeah, that's not me. I work from home, so I don't want to do that for my employees. Or they contract with licensed childcare providers, or provide childcare resources and referral services, right? So you can meet this in a variety of ways. How much is the credit? 40% of the qualified child care facility expenses. So if you're running your own daycare at the work, okay, 40% of what you shell out for running, keeping the little people alive is a tax credit. That's substantial. Or 10% if childcare resource and referral expenses, right? So there's the total credit is capped at $500,000. Um, what qualifies as a facility? You either have to operate a childcare center yourself or contract with an external provider to offer childcare to employees or offer a voucher or subsidy towards an approved childcare provider. And employer, you got to be keep in mind that the people that you're choosing have to be licensed under state and local law, be available to all employees. You can't pick a cherry pick and say, oh, these only these employees can receive this benefit. Has to be primarily for the employee benefit, not for the general public. Like it's got to be, hey, this is for our employees, and the facilities have to meet the health and safety standards, right? So to receive the credit, you have to set up the child care facility, contract, or referral service. You have to track eligible expenses paid directly by the business, file the Form 8882 with your tax return, and reduce the business deductions by the credit amount, right? So the workbook will help you if you're like, this could make sense, right? But you have questions. The workbook will help you craft your childcare plan or approach using the workbook. So grab that. All right, moving on. We're cranking through these. Research and development tax credit, R&D. Research and development, there's a lot of questions around this one. So let's kind of step away from the business and helping the employees and shift the energy right back into your business. So the IRS will pay you in credit or enhanced deductions to renovate, develop, or improve your services or processes, products through research and development tax credit. Also R&D tax expenses, right? There's some recent changes. So it rewards development of new products, improving existing products or processes, enhancing software or internal systems. Now, keep in mind that R&D does need to be science based. It does need to be hard science based. So soft sciences, if we're talking about improving our processes or systems for marketing or HR hiring, those don't qualify for R&D. Okay. But OB3, the One Big Beautiful Bill Act, updated to allow expenses to be in the past, you had to capitalize or say, hey, we spent 100 grand. Now we have to take that $100,000 and amortize it or depreciate it over a period of time. Now those things can be expensed immediately. Small businesses can go back all the way to 2023 to amend tax returns. Large businesses can deduct the remaining unamortized R&D on their current year or over 2-year tax returns, right? The R&D credit, it's going to be qualified expenses include wages of technical employees. That means engineers, software engineers, programmers, supplies used in R&D, uh, contract research, outsourcing to other parties. Keep in mind, it has to be US based. So you have a guy or gal in India or the Philippines or Pakistan, Iran. I've worked with some amazing folks in Pakistan who are very, very technically sharp. But those expenses for offshore do not qualify for R&D tax credit. Cloud and software development costs. I have a client right now who has been working with a US-based team they contract without offshore folks, but his contract is with a US-based team. He spent about 10 grand on R&D for software development. He's building an app from the ground up. I was like, hey, that's great. That was the first round. It was going to cost him nearly 100 grand. I connected with the guy who he's going to get it done in like 4 days, for like 2 grand a day. So half the cost. He scoped it out as a 4-day project. And he's like, yeah, we'll be done. Like deliverable product in 4 days. I was like, holy cow. So that guy is US based. We made that connection. So again, if you need connections in the business realm, folks, we do taxes for a living. We help all kinds of people and have amazing people that we work with. So reach out if you need help making connections in the business world. Okay, there's a four-part test. We're going to go over this briefly, right? Um, permitted use, right? It has to be that you have to have a like permitted use factor to say, okay, what is this going to be? How does this qualify? The technological in nature, the R&D has to be in relation to technology and hard sciences, so engineering, chemistry, physics, that type of thing. Elimination of uncertainty, you need to have if you're doing R&D and you're doing research and development, like you're not sure if, hey, what we're doing is going to actually solve the problem. So you want to be aware of, oh, this is going to give us we're not sure if this is totally going to work. So if you have 100% success rate in your scientific method of applying the to the problem, that's not elimination. There's no uncertainty. Like, hey, you have 100% success rate. That's not really elimination of uncertainty. And then the process of experimentation, so testing, modeling, prototyping, and simulating. You really need to show that each of these for qualifying expenses related to R&D that is technologically sound and of science kind of methodology. So how much is the credit? Generally 6 to 10% of the qualified expenses. And remember, if you say, hey, we spent 100 grand, we had a if it's 10%, we can take a 10% credit. That remaining 90% that was not used for the credit could still be deducted, right? We just have to reduce the deduction by the amount of the credit. And startups are offered, if you qualified startup, you're offered up to $500,000 a year to offset payroll taxes, which can be huge. Um, the biggest misconception here is that you need a lab coat and goggles, right, to claim the credit, but not really. Like the hard science, like I'm not in the medical field, right, doing medical lab research. There can be other things. So roofing contractors, HVAC contractors, dentists. There are several areas where you can say, hey, legitimately, we could be redefining or revamping our processes, but you have to be tied to technology and science-based activities, right? So the workbook will help you identify, are you conducting or could you be conducting, if you did things a certain way, R&D eligible activities. The research and development tax credit can be a huge win. I encountered a gal years ago. She came to me and she's like, I don't, I think I need you, but I'm not sure. And so we looked at her tax return. She had not paid taxes for a decade. And she was scheduled based on my projections with her to not pay taxes for another like 4 to 5 years because she had huge research and development tax credits that were wiping her taxes down to zero and rolling forward to eliminate her taxes on an ongoing period, right? So she was going to end up not paying any tax on any earnings for almost 14 years. Pretty wild. So that can add up if you're doing those things. Last thing, ADA compliance credit. So there are incentives for taking care of your employees, there are incentives for your business, but what about your customers? Well, one of those can be what's called the ADA compliance or disabled access tax credit. What this is a non-refundable credit for small businesses that have expenses for providing access to persons with disabilities. So what expenses qualify? Well, modifying your physical facilities, ramps, doorways, restroom doors, etc. Accessible technologies, screen readers, speech software, websites, ADA related training for staff, consultation for ADA compliance planning, and communication aids or sign language interpreters. All of those can be expenses that qualify. Uh, a big missed opportunity is a lot of businesses don't realize that their web presence, their marketing efforts are not ADA compliant. So if you're investing in making your virtual presence ADA compliant, closed captioning, etc., that can qualify for credits as well. If you need somebody that is a ADA expert, we've got an amazing gal. Her name is Sally, and she would be delighted to do a consultation with you to help audit your process and see, is there a missed opportunity for the credit, right? Who can claim the credit? You must be a small business with 1 million or less in gross receipts, or 30 or fewer full-time employees. S Corps, C Corps, LLC, sole proprietor, all qualify if they meet these criteria or limitations. How much is the credit? It's up to 50% of eligible expenses with an annual cap of the credit of $5,000. So if you spend more than 10,000, actually the first $250 doesn't count. It's a haircut. You got to spend more than 250, but then the next 10 grand count towards the calculation of the credit. If you spend more than $10,250 on eligible ADA expenses, then you use the rest as a normal business deduction. And at the end of the day, the credit is capped at $5,000. So to receive this credit, you must confirm you meet small business size requirements, either 1 million or less in gross revenue or 30 or less full-time equivalent employees. You have to track and document all your ADA upgrades. So you got to make sure that, hey, what I'm doing actually meets the criteria for ADA related upgrades, compliance, maintenance. Filed Form 8826 with your tax return, and don't claim the same dollars as a credit that you're using as a deduction elsewhere. So if you're already investing in ADA or you want to know what that looks like, check out the workbook. Again, that's in our VIP community, and help you capture. A lot of businesses can capture this tax credit if they just know about it and are aware. So you want to know something completely wild? These credits that we've gone through today are only a few of dozens of tax strategies available. Folks, the IRS does not want to teach you how to use the code to your advantage, right? That's why they have this roadmap that they've put together for us as business owners. But at the end of the day, the credits can be a massively powerful way to reduce your tax bill. If you are in the end of Q3 and you're like, well, shucks, these are kind of cool credits. Like if you're concerned or wondering if you're missing tax credits, again, there's state tax credits there. We've just touched on a few of dozens of tax credits that are available to business owners. Reach out. We're here to help in our free community. If you go to maketaxesfair.com/community, that's where you can join our free community, ask questions. In our VIP community that you can access through the free community, you can check that out there. That's where the workbook is. Appreciate y'all being here today. Thank you. I see a comment about the American flag. I love that. Thank you. I'm a massive baseball fan, and massive fan of keeping more of your hard-earned money. So with that, folks, I'm going to bid you adios. Thank you for your time. We are approaching the October 15th deadline, and there's tax work to be done. So I'm going to scoot here. Till next week. I think next week we're going to be tackling, I want to say, either board of directors or health tax advantage travel. So join us next week. We're going to be working on putting up some content in the school communities ahead of time before the webinar, along with the resources beforehand. So we're slowly and surely getting our proverbial crap together. Thank you for being here. If this has been valuable to you, please share this with a friend. Guys, friends don't let friends overpay the government. We're excited to bring this weekly content to you. But help us grow. This audience is completely free. Don't pay the ignorance tax by just not knowing what you should know as a business owner. All right. Thanks so much. Appreciate you being here. Till next time. Bye for now.